They told you support and resistance were lines on a chart. They handed you a ruler pointed at a few old highs and lows and said, "There, that's where price bounces. That's where it stops." And you believed them because it looked clean, because it looked logical, because it looked like something you could trust. But let me tell you something. I spent decades in this market, losing fortunes, rebuilding them, and losing them again, before I finally understood the truth. Lines on a chart don't stop price. People do. Fear does. Greed does. Memory does. And until you understand that, you will keep drawing lines that mean nothing and wondering why the market keeps walking right through them. Today, we are going to talk about support and resistance the way I came to understand it, not as a technical tool, but as a window into the psychology of every man and woman who has ever held a position in this market. This is not the lesson they teach you in trading courses. This is the lesson the market teaches you, after it has taken your money enough times that you finally stop arguing with it. Before we go any further, I want you to know that everything I share here is expanded beyond this discussion. We have put together two resources that I believe every serious trader should own. The first is our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. The second is the Livermore Journal, a 9-0 day trading psychology workbook. Both are there for a reason. Do not skip them. They will change the way you see this market permanently. Now let us begin where every lesson about price truly begins, with the human being holding the trade. When a stock rises to a certain level and then turns down, what happened? A textbook will tell you supply entered the market. Fine, but why? Why did supply enter at that exact price? Because people who bought lower saw an opportunity to exit with profit. Because people who shorted earlier finally got their vindication. Because traders who missed the original move decided this was too high, too fast, and placed their bets against it. Price did not stop because of a line. Price stopped because of human beings making decisions based on memory, pain, and expectation. That is the foundation of everything. Support works the same way, only in reverse. When price falls to a level where it previously found buyers, it finds them again, not because the chart said so, but because a crowd of traders remembers that level. Some bought there before and made money. Some missed a move and are waiting for a second chance. Some were shaken out at a loss and are waiting to break even. All of them are watching that level. All of them are ready to act. And when price returns to it, they act together. And price bounces. That is not magic. That is not technical analysis. That is the collective memory of the market expressing itself in real time. Now here is where most traders go wrong. And I mean most, including experienced ones. They treat support and resistance as binary. Either it holds or it breaks. Either the level is valid or it isn't. But the market does not work in binaries. It works in pressure and time. A level is not a wall. It is a zone of accumulated emotion. And the real question is never simply, will it hold? The real question is, how much pressure is building against it? And how long can that memory sustain itself? I learned this the hard way, in cotton, in wheat, in the great pools of the early markets. I watched intelligent, well-capitalized men draw their lines and place their stops with surgical precision, only to be destroyed when the market moved in ways their charts never predicted. The market did not break their support because it was technically wrong. It broke their support because the underlying story had changed. New people entered the market. New fears took hold. The old crowd disappeared. And with them went the emotional anchor that gave that level its meaning. This is the first truth you must carry. A level is only as strong as the memory behind it. When that memory fades, when the original buyers move on, when the conditions that created the level no longer exist, the level becomes a ghost. It still looks real on your chart, but it has no strength, and when price approaches it with force, it will not hold. So how do you tell the difference between a level with real memory and one that is already dead? You look for evidence. Memory in this market is not abstract. It is measurable. It is visible if you know what to look for. It shows up in volume. It shows up in time. It shows up in how price approached the level and how it left. These are the fingerprints of the crowd. Volume is your first clue. When a level forms with heavy volume, many participants are involved. Many have emotional stakes at that price. When price returns, those emotions react again, and the level responds. But when a level forms on thin volume, very few people care about it. And when price returns, there is no reaction, no crowd, no support. The level dissolves. Time is your second clue. The older a level becomes, the more the original participants rotate out. The crowd that created it may no longer exist. That doesn't make old levels useless, but it changes how you treat them. You must ask, is this level still alive with memory? Or is it only being respected because newer traders believe it matters? That answer should change your conviction and your position size. Now let's address something that confuses many traders. Role reversal. You've heard it said that support becomes resistance and resistance becomes support. That is true, but not for the reason most think. When price breaks below support, those who bought there are now trapped. They are in pain. They are waiting, consciously or not, for price to return so they can exit at break even. And when price does return, they sell. Their need to escape pain becomes supply. That is why former support becomes resistance. Not because of a rule, but because of human behavior. Understanding this alone will save you from countless bad trades. Now let's talk about execution. When I identified a strong level, one with volume, recency, and clear memory, I never blindly placed an order. I waited. I watched how price approached the level. Was volume declining, suggesting weakness, or expanding, suggesting strength and a possible breakout? Was price hesitating, or moving with momentum? I was always probing the market. I never committed fully until the market confirmed my idea. This is why I survived, not because I was smarter, but because I was patient and willing to be wrong in small amounts before being right in large ones. There is one more layer you must understand: the role of large operators. Big players know where retail traders place their stops. They know where obvious support and resistance levels are, and sometimes they deliberately drive price into those levels to trigger stops, to shake out weak hands, to create liquidity. This creates what I called a springboard move. Price breaks below support, triggers punny, see, and then sharply reverses. Retail traders are trapped, weak hands are gone, and the market is now free to move. This is not a failure of support and resistance. It is confirmation of it. Now let's bring everything together. The truth about support and resistance is this: you are not reading a chart, you are reading a crowd. Every line you draw is a hypothesis about human behavior. Every trade you place is a bet on how that crowd will react. And like all bets involving people, it is never certain. The only certainty is this: human behavior repeats, patterns emerge, and if you are disciplined enough to wait for confirmation, the odds will work in your favor over time. Discipline. It is not exciting. It does not sell courses, but it is everything. I was not always disciplined. In my early years, I acted on impulse. I saw a level, I liked the setup, and I acted without waiting. And the market made sure I paid for that impatience. Again and again, until I finally learned the lesson it had been trying to teach me all along. I placed the trade, and I paid for it, again and again. My greatest losses were never caused by bad analysis. They were caused by impatience. I saw the right level, but I entered before the market confirmed it. I saw the right trade, but I sized it too large because I was in a hurry to recover from a previous loss. I allowed my emotions, the very thing I was trying to read in others, to corrupt my own decisions. The market does not owe you a trade. It does not owe you confirmation. It does not owe you a clean level or a perfect setup. It is completely indifferent to your needs, your schedule, your account balance, and your feelings. And the moment you truly accept that, not just intellectually, but deep within, you become a different kind of trader. You stop demanding the market perform for you, and you start observing the moments when it naturally aligns with your thesis. Those moments are worth waiting for. And when they come, you act with conviction, because that conviction is earned through patience and observation, not built on hope. Now I want to speak directly to those of you who have been hurt by this market, those of you who bought a support level that broke. Those of you who watched resistance hold multiple times, only to short it and see price explode through it on the next attempt. I know that feeling. I have lived it more times than most ever will. And I want you to hear this clearly. Just because the level broke does not mean you were wrong. It means the market changed, and the old memory was no longer valid. Your job is not to be right every time. Your job is to manage your losses so they never destroy you, and to press your advantage when you are right so your gains outweigh all your losses. That is the entire game. Everything else, every indicator, every system, every strategy exists to serve that one principle. Lose small, win big. And if you want to do that using support and resistance, you must be ruthless. Ruthless about the quality of the levels you trade. Ruthless about exiting when a level fails. Because a level breaking is not failure. It is information. It is the market telling you the story has changed. Listen to it. Do not argue with it. Do not average down hoping it will come back. Take the small loss. Reassess. Wait, there will always be another opportunity. Now, I want to connect this to the broader framework we are building together. This is not a standalone lesson. If you have not yet studied market turning points, tape reading, and trend psychology, go back and do that, because understanding support and resistance without understanding trend context is like knowing individual words but not being able to understand a sentence. You must see the whole picture. And now let me ask you something important. Do you keep a trading journal? Do you write down your reasoning before every trade and reflect after every trade whether it wins or loses? Because without that process, you are simply repeating mistakes in the dark. The market will keep charging you tuition, and you will keep paying it without learning the lesson. That is exactly why the Livermore Journal exists. A 90-day trading psychology workbook designed for structured reflection, discipline, and pattern recognition. Not on the chart, but within your own mind. Because that is where real improvement happens. Go and use it. Before I close, let me leave you with this. I have lost everything more than once. And I have built it back more than once. And I have built it back through the highs of being right and the devastation of being completely wrong. The market taught me one truth above all else. The market is always right. Not always fair, not always logical in the moment, but always right. And your only responsibility as a trader is this. Align yourself with what the market is actually doing, not with what you wish it were doing. Support and resistance, when understood properly, is one of the most powerful tools you have for that alignment. It shows you where the crowd has been, what they felt, what they fear, what they want. It reveals where the battle lines are drawn. And if you are patient, if you are disciplined, if you wait for confirmation before you commit, it will show you, again and again, where the next great opportunity lies. That is the truth about support and resistance. Not a line, not just a level, but a living record of human hope and human fear, updating itself with every tick, every candle, every session. Learn to read it that way, and the market will never look the same to you again. If this changed the way you see the market, then do 3 things. Like this video so more traders can find it. Leave a comment with why, our biggest takeaway, and share it with someone serious about improving their trading. You might change their journey. And remember, the 2 resources are there for you. Thinking like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk, and the Livermore Journal, a 90-day trading psychology workbook. Everything we discussed, and more, is waiting for you there. The market will open again tomorrow. Make sure you are ready. There comes a moment in every trader's journey when everything slows down. Not the market, never the market, but you, the noise that once controlled you, begins to fade. The need to trade every move disappears. The urgency to be right weakens, and in its place, something far more powerful begins to grow. Clarity. You stop chasing price and start understanding it. You stop reacting and start observing. And most importantly, you stop fighting the market. Because you finally understand something most traders never do. The market is not your enemy. It is not your teacher either. It is simply a mirror. a mirror that reflects your discipline or your lack of it, your patience or your impulsiveness, your clarity or your confusion. And every time you place a trade, you are not just testing a setup, you are testing yourself. This is where support and resistance transforms from a tool into an edge. Because now, when price approaches a level, you don't just see a line. You see behavior, you see hesitation or aggression. You see fear building or confidence fading. You begin to read the story behind the movement. And that changes everything. Because trading was never about predicting the market. It was about positioning yourself when the odds quietly shift in your favor. That is what patience gives you. That is what discipline protects, and that is what separates those who survive from those who disappear.